So before we get into the EIA segment 2, I'd like to remind you, please like, share, subscribe. Your support is appreciated. If you have any questions, always like the back and forth in comments, or you can find me on Twitter at @MarkFNY. So now when we look at the U.S. product supplied, we wanted to talk about some of the different setups. And so when you look at the current, so when we take the average of gasoline, jet, distillate, residual, you can see that we closed out the week at 15.22 million barrels a day of demand versus last week of 15.0109. But then when you look at that 4-week rolling average, we're right at about 14.935 million, and we expect to kind of follow that average, if you will, as we go forward. And then when you look at the averages from 17 through 2020, you can see just where we sit. So 17 through 19, we're right kind of moving in line just below where we were in 19. And as we've been saying, we expect to just go sideways from this point because gasoline will be a bit lumpy. But if you look at gasoline and distillate right now, they're essentially every other, where gasoline will have a good week, distillate will have a down week, and then they'll kind of flip and you'll see some of that movement. But distillate is just not going to fall as much as gasoline is, which again is going to keep us fairly close to where we were. Because what's missing from jet, what's missing from distillate is what's missing from jet and gasoline is being made up by distillate, and that's keeping us fairly close to some of these historics. Then when you look at just where we sit going forward, you can see that 2019 kind of has started to see some of that movement. And when you look at the weekly numbers, we just had a little bit of a bump a bit later. As we were saying last week, we didn't expect to see that as huge of a drop. Again, we had a huge increase, we had a huge drop, and now we're kind of right back to where we were. But then on the gasoline side, we expect to come closer to about 9.1 over the longer term as we go through the remainder of not only just October, but into November. And that's going to kind of be some of that topping point, because we're just not seeing a significant amount of demand into Latin America and just our historical normal, which has been both LATAM on the gasoline side, but then Europe on the disti side. So those are going to be some of those shifts in general. And remember, like last week, the total gasoline arrivals were expected to be at about 340,000 barrels a day. They came in closer to 383. And then some of that was just pulled forward, which again created some of this lumpiness. But we'll talk about that a bit more as we go through the remainder of the segment. So then when we look at what's happening in distillate. So distillate had a small build of 380,000 barrels. About 18 million off the 5-year average. But when you look at just who makes up that shortfall, 12.5 million of it is Pad 1. And Pad 1 had a draw of 730,000 barrels. So there's going to have to be a setup of how do we close some of this gap, because we did lose the Philly refinery. That created some of these shortfalls. And that's when you look at imports increased from 184,000 barrels a day to 300,000. So an increase of 116,000 barrels a day. And it was really driven by Pad 1, which had an increase of 121,000 barrels a day of imports. And again, this is to try to close this gap. Even though the spread is very much open coming into Pad 1. So as you have this Asian product coming into and Middle Eastern product coming into the Atlantic Basin, it's going to have optionality. It can either continue on into Europe or pivot into Pad 1. And that's where we're going to see some of these different backdrops that we're going to have to look at, because if we have a cold winter, you're going to see a significant amount. And then at what price does it make sense to use a Jones Act vessel? Because remember, a Jones Act vessel is necessary to import from a U.S. port. So in order to go from Pad 3 to Pad 1, you need a Jones Act vessel to do that, which is something that is manned by American sailors, built in America, flagged in America. So again, those are some key criteria. And because there's just less of them, they demand a premium in terms of price. So that's going to be, if obviously there's Colonial Lines 1 and 2, but if the price makes sense, then you'll start to see some of these boats going from Pad 3 into Pad 1. And when you look at Pad 3, you can see that there was a build of almost 1 million barrels, and that's only 3.3 million off of the 5-year average, and Pad 2 is only 1.6 million off the 5-year average. So that's where we're going to see some of these pivots. Pad 4 and 5 very much in line. But as we see and as we've been talking about in terms of how much production is coming from the U.S. So when we look at production, you can see that there was distillate production increased by 195,000 barrels, going from 29% to 30.2%. And that was really created by Pad 3, which had an increase of 166,000 barrels a day of distillate production. So again, that's going to be how do you get it from Pad 3 to Pad 1? And when you look at just historics, we're well below the 29-year average. We're starting to kind of pivot back up. And if you look, this is when we start to see some of these drawdowns. And just given where we sit on the import side, where the boats are, where our production is, we should see storage just go sideways. We know there's enough demand to keep it where you're going to continue to see some of these steady draws, but then there's going to be that supply response, which is going to keep us fairly sideways. And as you can see, the comps get a bit easier. So that's just, it's still going to be a bullish backdrop, but you should see the comps, again, that ease of which, as the 29-year average comes down, you can see the top of the cloud kind of comes lower, the lower end of the cloud comes up. And that should, again, kind of tighten things. Still in a good position. So regardless, you're still going to see a lot of that demand side. And then as we look at demand overall, as we were saying last week, we expected to see it fall, still remain above the 5-year average. And here we are. We expect to see, again, just staying above that 5-year average and just kind of walking up that seasonal increase. And it's really, again, driven by trucks. I mean, look at where we were. We were saying getting close to about 175 on the market demand index, and here we are. We're at 164. There's a little bit of additional pressure going up to the upside. You can see against historics, very strong. Load availability is there. And then you look at rates. There's some pushback on rates when we'll talk about what's happening in terms of diesel, in terms of labor. But again, you're starting to see some of these rates just stay at the high end, but a little bit of pressure trying to pass it through. So that's something we're going to have to look at when we look at labor prices and diesel prices, of how much can continue to get passed on. But regardless, there will be enough of that demand. And then the reason why is, again, we have that shortfall in terms of labor, the chassis on the rail side, but you are seeing some of these increases. So total car loads were still up 6.6%. And as we were saying the last few weeks, it continues to be driven by coal and metal ores and metals in general, as that continues to try to move through the system to try to, again, prepare for the winter, keep some of the coal facilities operational. We will see grain start to pick back up. There was a lot of issues in Ida as some of the grain facilities were damaged. So that'll start to come back. Motor vehicle and parts is going to be a huge headwind going forward, just because you have the shortfalls in the assembly line, not having enough parts. So that's something that we expect to continue. The petroleum and petroleum products is going to be interesting, though, because if it's expensive to go on Jones Act vessels, does it make sense to try to rail some of this from Pad 3 into Pad 1 and throughout, 1A, B, and C? And that's going to be something to watch. And it's all going to come down to economics. What is going to be the cheapest form of travel given where the spreads are? And that's going to be something to try to manage, as intermodal also came under pressure, falling to down 7.3% versus last week, this week in 2020. Now, one of the other big issues is when we look at BNSF and the derailment of an Amtrak train on their line going across the north. So that's going to disrupt a bit more on the intermodal side versus some of the others, but that's going to become a little bit of a sticking point. They've already tried to do things to offset that. But given where that is and how there's not as much rail around there, just given it was a very specific line going across the north, that will impact some of the things, everything from intermodal, how much proppant and sand was going through to the Bakken on that. Those are going to be things to watch. And then how much crude was coming down, because there was some blending that was happening out of the Bakken coming south. So again, there's gonna be some shakeup, but again, there'll be some logistical adjustments to address that over the next few weeks. And now when we start looking at what is happening at the port, so the port continues to see a climb of assets. You can see essentially first week of October continues to see an increase in general, which previous week is up 55% versus last year up 56%. And one of the things that we continue to see is when you look at week 40 versus week 41, week 40 is really high. Week 41 is still a little bit lower versus last year. But as time goes on, you just see boats coming up. And as the issues remain, the bottlenecks persist, that's when you continue to see some of these assets just sitting on the water. So again, we don't see much change and things, but it will keep diesel demand up because you will see trucking, you will see more rail trying to clear the containers. Then when we look at temperatures, temperatures in general are fairly just either normal or above normal or just slightly above normal. So we're pretty firmly into fall right now, and that just means that instead of it being in the low 60s, you're in either the high 60s or the low 70s. So you're not using as much AC, you still don't have your heat on. So this is just kind of that meandering mildness as we go through the fall. We're still pretty short on expectations for storage. We still have a lot of LNG going off into the open market. As we talked about in our presentation to some clients, LNG is going to continue to be robust. We're starting to see some of that shift on completions going from oil into natural gas. We expect that to accelerate, especially in the South. But this is just, again, showing some normalcy as we go through the fall. Now, when we look at gasoline had a small build of 190,000 barrels. You can see it's about 6.1 million below the 5-year average. But when you look in general, and as we've been saying, we expect there to be that sideways move because we do have a lot of imports. We still are kind of the nicest house on a terrible block when you look at light distillate. So that's going to keep these imports moving in. And then just in terms of price, we're at almost $3.18 on a national level. So you're going to see some of these movements coming through, which is going to keep us fairly firmly to sideways, and maybe even some increases. But I just expect more of a sideways move. And just when you're considering what that means historically, that just puts us in a better position because the comps get easier as we progress through October. So when you look at Pad 1 had a build of 1.53 million. And then you had Pad 3, which had a build of 820,000. Pad 5 had a draw of 1.84 million, which was really the offset. And Pad 5, now Pad 5 still 1.6 million above the 5-year average. But you're getting some of this lumpiness, but the price of gasoline in Pad 5 it keeps the arb wide open coming from Asia, especially when you look at China, because China, they had a drop in exports, refinery exports in August, but you've seen a big step up in exports in September. So that'll, again, displace some of this cargoes and push more gasoline, more distillates in general coming into Pad 5. Now, when we look at gasoline imports, again, that drop of 92,000 barrels a day, still 204,000 above the 5-year average. And a lot of that growth was driven by Pad 5 with an increase of 163,000 barrels a day. Pad 3 got a bit more, fell to a more quote unquote normal number where you had a drop of 210,000 barrels a day, but right in line with the 5-year average, because Pad 1 and Pad 5 is typically that gasoline growth side. So now as we go through and we want to look at what are some of the different economics of what comes next, we just want to look at what's happening in general. So this month, what did we have? So this month's European refined fuel exports to Americas are set to reach the highest since March, when shipments on the route surged to replenish U.S. stockpiles following the big freeze. So when you look at February into March, remember the Texas freeze off, you had that huge surge. Then you had Ida. So now you had that response to Ida. So transatlantic flow, fuel flows from Europe to the Americas, mostly gasoline and blending components, are set to reach a 6-month high in September. at 3.8 million tons. So again, that big surge. So we did get a little bit of a drop back this week, but net for the month, we did get that big response. And some of that does continue into October based on what has been signed up in Asia, in Europe, and what is already on the water en route to the US. So September exports will be the highest since 2017 when Hurricane Harvey related disruptions raised flows. So just give you an idea of kind of where some of the adjustments are. Weekly inflows of European fuels in the U.S. based on the arrivals are set to be about 555,000 tons in the week ending October 2nd, which compares with a revised 769,000 tons in the previous week, which was the highest since the period ended March 13th. So we're starting, remember what drove that was you had some blending shortfalls within Europe. So even though it was classified as gasoline, it was really closer to naphtha. And that was something that was coming through. Now you're with the electrical issues, you have a lot of petchem either pausing or slowing some of their activity just because it's so expensive to operate in the region. So that's where you're going to see some of that slow down and some of that will increase into storage in general. And then on the blending component side, we had a build of 1.07 million, which is just 1.4 million below the 5-year average as blending components continue to stock up, which I think is a much bigger issue, especially as we go through the remainder of September, because as we go through the remainder of this week, and then really into October, because we're just not seeing that underlying blending demand, which is a little bit of a better gauge of kind of where are we going through, how much of this is moving in, and just where the economics are. And gasoline continues to be a bit of that overhang. Now, just looking at where that demand is coming from. So according to Pay with Gas Buddy data, weekly U.S. gasoline demand last week rose 1.1%, ending the 5-week streak of falling demand. Weekly demand was the highest since the week of August 29th. Now, as we were saying the last few weeks, you're going to have that seasonal drop, and then you're just going to level off, and then you're going to waffle back up and down, up 1%, down 1%, up 1.5%, down 2%. And that down move is just going to be weather-based. Do we have a snowstorm? Do we have a really bad rainstorm that's going to impact some of that weekly moves? But again, you're just going to be, going sideways because flexible schedule, work from home is still very real in society and continues to shave some of that weekday travel as weekend travel continues to be a bit more robust versus 2019. And as we've been saying, weekday is about 10 to 15% lower, with weekend travel being zero, either flat to up 5%. So as we started this week, Monday, U.S. gasoline demand rose 0.6% from the prior Monday, but was down 0.8% versus the average of the last 4 Mondays. So again, just seeing some of that stability as we go through the remainder of this week. And here's one of the big things impacting it. When you look at gasoline prices, we're right at $3.17.5. And that's, we fell almost a full penny, but we should be falling. We're now well past the summer driving requirements. We're now into winter grade, and we're not seeing a huge drop, which is impacting the way people drive, impacting how much they're looking to spend. And then even more importantly, when we turn to diesel prices went up another 2 cents. So now while gasoline fell almost a penny, diesel went up 2 cents. So we went from $3.38.5 to $3.40.5. So again, that is impacting things that you buy more and more. And that's where I think there is a huge issue in terms of how the pivot goes and where this inflation is going to show up. As we talked on Ryan Ray's show yesterday, pretty much all pasta is now below £1. You're seeing the shrinkflation, trying to shrink the amount that's in the box and keeping prices flat. And this is why, you're trying to shave off penny, 2 pennies. How do I look and try to adjust this to keep things flowing? If you look at the color, the size, the shape, that box looks exactly the same, except there's just less weight in it. And that's where we continue to see companies trying to manage some of these movements. So then when we look at blending components, as you saw, the kind of that steady move up, comps get much easier just given where we sit. So even though we're still low on a 2021 level, when you look through the historics, this is kind of where we see some of these increases, some of this tightening. And we just expect this to continue to go sideways and move fairly stable. So here, when you look at gasoline product demanded, you can see that there was a nice spike up to the highs. And as we were saying, we expected to see a bit of a spike last week. Instead, we just had a bit of a sideways move. So now we're getting a bigger spike this week. It's just that lumpiness continues to move through the system. So then when we look at the last 5 weeks, 5 years, you can see just where we sit. So typically we get and if you look over the historics from 16 to 19, we typically got a spike this past week, and then you get the big drop. Instead, we had a pause, and now we're having a spike where the other 3 years we had a down move. So that's why we always talk about using that average, that just because it can be a bit noisy. But we do expect to drop, but nothing crazy. Like, we're not expecting to drop to, the recent lows. It's just a move back to about 9.1 is where we think the market is going to sit as we go through October. And then when we think about why. Well, why is that going to happen? Well, look at that workplace side. So workplace is leveled off, seeing, again, still about 20% off normal about going to the workplace, which just means those people are either working from home or working a flex schedule, which is offsetting that. You're starting to see some, retail recreation slowing a bit. Grocery, pharmacy kind of walking its way back down. And then parks, as they did last year. As it gets colder, people don't want to go to the parks as much. So again, you're going to see some of that just very seasonal slowdown. So the park is a highly seasonal slowdown, nothing to extrapolate from that specific thing. The overhang is the workplace side, which is why we always designate the difference between weekday and weekend. And here's where we start talking about Apple. So mobility trends, where you had last year, we had that spike and then we had that fade back down. Here we have that spike, and now we're seeing some of that gradual move down. And it's, when you compare it to last week, fairly stable, not much up or down movement. As we've been talking about, like the movement down will be a bit more gradual, because if you think about what happened in October and November, we had a spike of COVID. You had people looking to slow down just so they could see family on the holidays. So again, that's where you're going to see some of these adjustments, which is just, again, it'll just be more gradual, but there still is that seasonal impact that we've always talked about. On the propylene side, we had a build of 2.64 million, but we're still 17 million off the 5-year average. And you can see when we look over the last 5 years, we're still at the lowest level that we've been at since going back to 2016. So again, we're still in a very bullish position for not only pricing, but also for where we can shake out going into the winter. And days of supply. So days of supply, this is a little bit delayed, so we will get a little bit of a tick up, but we are seeing more demand when you think about petchem, when you think about exports. So there's still more usage. So even though we got an increase in storage, we still have an increase in demand. So that's going to offset kind of this the days in supply, which is why we could very well get a much bigger issue as we go into 2022, depending on how cold the start to the winter is and where we sit in January and February. So then when we start talking about vaccinations, the pace still remains fairly stable. The increases remain strong in Asia, Japan, Vietnam, Indonesia, India, rounding out the top. India slowed down a bit, but still remains over 50. With the world also slowing down a bit, but that's also the difference between developed versus emerging, and just population densities. So again, that's not anything too terrible, as China continues to be a bit slower in terms of where they'd like to be, but they've had some decent increases over the last couple weeks, because typically they try to use outbreaks as a means of driving people to come in and get vaccinated. U.S. continues to slow down, but because we're reaching kind of this point of 60% where the Delta are people that may not want to get vaccinated, so we expect that to continue to slow. And this just gives you an example of what that means of slowing. where typically if you're seeing the pace stay steady, you should see the share of people only partly vaccinated should be essentially steadily increasing or holding firm as the fully vaccinated number increases. So instead, when you look at the U.S. is you're seeing a slowdown on the partly vaccinated as the fully vaccinated individuals catch up. And that's where we're getting closer to that 60 some odd %, which is where we're seeing some of those hurdles. And the same can be said again in Europe, where getting to that 70, 75%. The one to watch is going to be India, where they did get an increase in that partly vaccinated, because the hope is that once you get to this point, even if there's an outbreak of a new strain, it won't be as impactful. You won't have to use such extreme measures to keep the economy going, and especially in some of these key areas. Now, when you look at worldwide commercial flights per day, as we were saying the last, since March of this year, we expected to just kind of split the uprights, where you were going to be better than 2020. You weren't going to be at 2019 levels. You still had restrictions on international flights, and people just don't feel as wealthy. And this is when you're looking globally. This is not just a U.S. comment, as we cover in our econ show, and that's going to continue to be some of that overhang. And then corporate travel, how much corporate travel is necessary? It's expensive. It hurts your green score if you want to manage your ESG. So again, there's some of these overhangs that are going to be less about COVID, because COVID forced you to change the way you did business. And now you can't replace face-to-face. That's a fact. I'm not refuting that. But how much face-to-face is being changed? And do you need to see clients 3 days a week, 3 weeks a month? Or can you do Zoom, 1 day a week and see that person 1 day a month? And that's where we're seeing some of these pivots in terms of the way corporate travel works, which is, again, showing up in jet demand. We had a small build of 230,000 barrels, again, right in line with the 5-year average. But the demand side was, and as we were saying, as things tighten up a bit, the fluctuation in demand is not going to be as extreme as we've seen in through the summer months. Instead, it'll tighten up a bit, and you'll see it. We'll still get increases up and down, especially as we talk about Thanksgiving, Christmas. You will see some of those spikes, and you can see where those spikes are when you look at the top of the cloud. So we will see seasonal recoveries. But they're seasonal for a reason, because they also happened in 16 through, even through 20. It's just that 20 was at a much lower level. So again, that's going to be something to look at and manage. And we'll talk about that as it comes forward. But as we go through October, we continue to see kind of this small backdrop of maybe just below 1.4, about 1.47, maybe 1.5, and kind of sitting within this fairly tight range. And here's why. Is when we look at what's happening right now. So the average number of departures per day increased by 1.2%. A lot of that was done by Asia Pacific. You saw some of those recoveries where when you look at North America starting to roll over, Europe is holding fairly flat, and the same with the rest of the world. We expect Europe and the US to move more along the seasonal line, and Asia Pacific, again, kind of still seeing increases. We're going to get back to what we would say is kind of that June high, with the rest of the world, again, staying at this level because it's already seen that reduction, as we go forward. And then globally, the passenger flight schedule for the 11 weeks ahead declined by 1.3%. Asia Pacific led cuts. So that's where, as we look forward, that those cuts are off of what should be normal. And that's when we look at what is normal, you're just seeing some of these reductions, and that's where you're going to see the departures continue to be under pressure, which is being shown by the TSA passengers as we continue to be well off of normal in terms of the peak levels coming to the bottom of 2019, but then you get that big drop down in terms of just where we sit right now, without much change. So some like to talk about Delta as being the reason, but when you look at just how this chart looks, it mirrors 2019 almost perfectly, just at a reduced level. And that comes down to, again, just a little bit less travel on the personal side, not as much travel on the corporate side, and then that international travel just not being there. So we're just at a reduced level, and that's going to continue to be the case through 2021. And then when you look at local activity, open tables showing us that, again, just kind of confirming what we've been saying, where weekday is just going to have those headwinds. Right now, they're about that 10 to 15% decline versus previous on the weekday, with weekends being 0 to 5% higher. And again, you're continuing to see that hold true in a lot of facets of life, in terms of restaurants, in terms of, and again, it's just, if you're working from home, are you going to go out to eat, or you're going to stay and have lunch in your house? And again, that's where you're seeing those reductions on the weekday versus the weekend. And now that we've gone through that, in the next segment, we're going to start off with OPEC and then go deeper into the U.S. export profile.